afternoon once again. Yep, Stu, it's that time again for Coach's Corner. Man, these things seem to roll around daily. Seems like we were just talking about this, but this is actually what we might call part two from last week. So if you joined us last week, we were talking about some of the problems with what we might call tail bets. Everything's actually a tail bet with options. That's something that a lot of traders miss. But we find that a lot of people misunderstand this whole idea of out of the money ends. On one hand, they think they're safe when they're selling puts, then they think they're safe when they're buying calls. People get this stuff completely backwards.
Right,
And
right.
as we always say, if you want to know what's going to cause more traffic accidents than anything, is driving the wrong way.
Yeah, that's a problem.
It is a real problem.
Even though
And
people think they're driving one way on a one-way street, even though it's the wrong way, they think it's okay because they're only driving one way. Look, John,
exactly, they say, hey, what's the problem, officer? I'm only driving one way.
yeah,
Exactly.
John, our one of our illustrious founders, John Nigerian, actually spoke about this very briefly
Yes,
at
he did.
our recent conference in Chicago. He
Yep.
was mentioning the idea that some big names in the industry, Buffett, Michael Dell, what's a Microsoft's guy? Oh yeah, Bill Gates, right? That guy.
I've heard of him.
Was they're big sellers of puts,
Yep.
and John was talking about the distribution,
Yeah.
and that's what we focus. That's what we're focusing on here. We're focusing on where are you falling on the distribution of
Correct.
where is it that you're selling the puts? This notion of like, oh, I'm buying time in the out of the money calls, and that's going to save me, and I don't even have to look at it because I got a year and a half. Nonsense.
Not
Uh,
true.
Look, I can sell these puts and it's free money. It's
They're
like,
so far out of the money and it's not going to happen.
it's
It's
that,
free.
it's free. No, and it's not a, look, everyone, we say this every week. It's not a go or a don't go. It's not a no go or a go. It's not a, we love it, we hate it. It's none of that. It's getting you guys to understand
What you're
how
doing.
this really plays out. What is the problem? What is the good part? What's the risk? What's the up and down? What are the pros and cons? How does it work? Where's the risk? Where are the holes? And how can you look at it with an even eye without saying, well, this is free money, because there's nothing free about it.
Nothing at all. So let's take a look with our chalk talk. Should be a pretty obvious direction where we're going here. So here's our chalk talk question, which we will answer at the end. Selling out of the money puts is easy money. Now, some people might say, "Come on, you can't be serious." We are dead serious. Why? We see it every
Every day.
single day. We
Every
see
day.
people in the chats going, "Oh, I just sold these puts that are 20% on the money, gas money for the weekend." You go, "Oh,
Or
great,
some
Dave.
other, like, oh, if you can get 1%
You
of
can get
something,
1%. It's a great deal.
it's a great sale.
A great sale."
Yeah,
Yep. Thanks, Dave. Well, I'm on it right now, and then everybody jumps
yeah,
on it.
yeah.
And the illusion is that they say, "Well, it's so far out of the money." And they're just thinking about the probability side, but there's another aspect to it. And this is the problem that people miss.
Or how about this
So,
one, Bill? Oh, the vols are pumped, so I'm going to sell these puts. Look at the premiums that I'm getting.
and there's a reason you're getting them.
Yeah. Do we have to talk about that?
We will. So let's talk about it again. Now, this is kind of part two from last week. We gave it kind of a catchier title here, but it's really a part of a bigger presentation that we have about this whole idea of distributions and understanding that everything you do, calls, puts, long or short, is a tail bet. It's not, oh, I think it's going up, and hey, this option is only $3. It's a good deal. It's the wrong way to approach it. So here's our title, Stu. The tail you ignore is the one that bites.
Hey, Bill. So if you have an option that's $3 and it's a good deal, if I found an option up there that's 50 cents, is that like a better deal?
It must be a better deal.
Must be.
Yeah.
I think I
And then we're
read
going to
that. I
also
think that's in
talk
my
about,
rule book.
yeah, exactly. So there's all kinds of misperceptions, and people, quite honestly, are forgiven for them. They're easy traps to fall into. But now let's talk a little bit about a little overlap from last week, a reminder here that when we look at whether it's stocks or options, options are based on the stocks, but the stocks move according to a bell curve. Now, to be clear, when we say this, we are talking about the what we call the returns. So if the stock is 100 yesterday and trading for 101 today, that's a 1% return. And if we were to plot those, lost 0.75%, gained a quarter, whatever, we map all of these out and we count the number of times that they fall in those little buckets, we would get a bell curve. And this is how all of the options are priced. We're going to do a nice little visual in a little bit, but always remember that this blue area, the 1 standard deviation mark, that about 68% of your data will fall in there. Blue plus gray, this entire range here, is 95%, and then almost 100% will fall within 3 standard deviations. Now, here's the part that people miss. We talk about this in our Q&A, the EV triangle, the expected value triangle. This is something that we know in the world of finance and kind of on the academic side, but I think it's super important. And so what it turns out is that when you are placing a trade, you can choose the win rate. You can say, I want to let me look through the list here and find one that wins 80% of the time. You're absolutely free to do that. You're not pulling any fast ones. You're just slicing a different part of that curve. But if you choose the win rate, here is the catch. Do not forget this. That the market is going to choose the average loss and the probabilities. I'm sorry, and the size of those gains. Now, you could also choose the average gain. Hey, I want to make $1 on average. You can do that, but then the market chooses the rate and the size of the loss. You can also say, I only want to do trades where I hold myself to a certain loss, but then the market chooses the gain and the probability. You cannot say, I want an 80% probability to win $5 and a 20% chance to only lose 10 cents. And that's how people think. They think that they get all of the good and none of the bad. Okay, so it's one of these things. So the expected value triangle, again, you can choose the win rate, you can choose the average gain, you can choose the average loss. But here is the catch. The market forces the expected value to 0. So what does that mean, Stu, when we say the expected? Well, it's actually a good word. It's a mathematical term, but it's a very good word. It means if you were to do this over and over and over, not counting commissions, what should you expect?
Not 5 times I got lucky.
And not 5 times. Right. This is
Right.
hundreds or thousands of times under identical conditions that you would expect to be 0. So it's like if Stu and I are going to flip coins dollar for dollar, we would expect to break even in the long run. But at any given moment, one of us could be up and the other down. But that doesn't mean it's a violation of this idea that the expected value is 0.
I think they call that an auction market, don't they, Bill?
And we're going to see why. Because a lot of people say this can't be true. That's just academic nonsense. Well, let's think about it. Let's dig a little deeper. Let's say
Listen,
you have an
there's a
80%.
buyer and a seller. There's always a buyer and a seller, everyone, right? I mean, somebody's buying it because they think it's good, and the other guy's buying it or the other guy's selling it because they think it's good.
That's
How
right.
can both of them be right or both of them be wrong? I
Right.
mean, it's got to come out to 0 at the end of the day.
Right. So if you have an 80% chance to win $1, now how can we figure that out? Well, we look at our bell curve, we look at the volatility, that's what gives us the width, and we say, based on this time and this volatility, there's an 80% chance that the stock is going to fall below, let's say if we're selling puts, that it's going to fall below that. Okay, you're going to win under those identical conditions 80% of the time. You can pick that. If you want to pick 80%, the market is going to choose this. If you want to choose the dollar, the market's going to choose that. But then the market also does what? It says, well, if you have an 80% chance to win, obviously you have a 20% chance to lose. That's another big part that traders forget. But the market also chooses this. You cannot say I want an 80% chance to win $1 and 20% chance to lose 10 cents. It doesn't balance to 0. So if we were to multiply these out and add them up, I should have put a plus sign over here, but if we added them up, we would get 0. So one way we can figure this out is we look at this ratio. All right, we have a favorable edge because we're winning 80%, at least in terms of the frequency. We're winning 80% and losing 20%. That's a ratio of what? 4 times. And what that means is that if the reward is $1, the loss should be what? 4 times as big. This is the part that traders miss.
So next time you're looking for, I want a win rate of, 90% or 80% or
You
whatever
can
number
choose
you
that.
want to pick.
Sure.
Think about the idea that there's another side to that equation, and that's not really giving you the edge.
It's not. Why is it? Because the edge is zero. There is no edge. Right now, again, we have to be very careful about that. That does not mean that you're not going to win or that the seller's not or the buyer seller's not going to win. It's exactly like a football game with a point spread. They might say there's a 10-point spread, but there's still a pretty low chance that the game is going to be exactly 10 and that it just becomes a push and a zero. But that's the expectation. You shouldn't say that the home team is favored or the away team is favored. That's the whole point of the spread.
It's also worth mentioning, in the beginning of this part right here, Bill, you had said, the market's creating these prices, and you said
Yep.
something about the volatility. The market is doing that work for you. You can't say,
Nope.
well, the market's trading at 50 vol, so I want to trade it at 40. That doesn't work.
Nope.
The market is saying this is it.
This is it.
Step up to the plate or beat it. That's
You
the
can
way.
choose a slice on that bell curve,
Yeah,
but
yeah.
you're still playing under the same bell curve.
That's right. That's right. You
Okay,
you
so
might be playing in different places on the bell curve.
and that's what trading is really about. Yep.
Yeah. Yep.
So here's another way for everybody who likes to look at, hey, I've got an 80% chance of winning a buck. Flip it. Stu talks about that all the time, don't you? In our Q&A,
Look to the other side.
he'll
Look at
say
the other
flip to the
side
other
of the
side.
trade. Don't think about what you're doing. Think about what the other guy's doing, and
I
then
could
talk.
all I could also just as easily say I could lose 4 times the amount that I can win because that is exactly mathematically the same thing for this reason. If you have a 90% chance to win and a 10% chance to lose, 90 divided by 10 is what? Or zero point 0.9 divided by 0.10 is 9. That now becomes 9. Okay, that becomes a very big potential risk. And why would anybody take the other side? So think about this. Like, and again, we get a lot of pushback from people that'll say, "Oh, that's not true. That's an outdated theory. That's just academic stuff. We can find these little pockets of gold." Not true. And here's why. Let's say that we have a 50-50 shot. I like to use a seesaw, and we put a 1 pound weight over here or a 100-pound kid or whatever you want to do. We have some weight over here. What do we have to do to put on this side to make it balance? Well, it's got to be the same. So if it's a 50-50 shot like a coin flip and I'm willing to uh, lose $1, I should be able to win $1. That should be my expectation. Otherwise, I'm not playing. But now watch what happens if I say, oh no, I'm going to pull a fast one on the market. I want an 80% chance to win. Look how smart I am. I went down the board. I looked at my pricing model. I've got an 80% chance to win that buck. Fine. But the seesaw has to balance. Why? Because nobody's going to buy it from you. That's the whole point. Why do you think that you get all the good and somebody's out there going, yeah, I know I'm taking the bad side of the deal, but here you go. Not going to happen. This is a competition, people. It's a competition. We talk a lot about this in our Q&A where people seem to have this image of Wall Street that there's this giant ATM sitting on top. And if you learn your rules, you can reach up and just pluck this free money. They don't realize you're sitting at a poker table.
I got a
And
funny
the
story about that. I'll
and
tell you
the
that.
only
You're
way
on.
that
I'll tell.
the only way that you get paid is by somebody sliding money across the table. They're not going to do it for free. So if you have an 80% chance to win, yes, you can pick that up, pick that out. Market's going to choose that. Obviously, you have a 20% chance to lose. But what's the other side? What does this have to be to make this seesaw balance if this arm right here is 4 times as big as this one? Got to be 4 times as big. There has to be a $4 potential loss. So the higher the win rate, the greater the loss must be, the potential loss. And people miss that. Now again, why would this make sense? Some people go, well, that's not true. That's just theory. But why would somebody say, I want a 20% chance to win $1 and I'll lose $1 80% of the time? Good luck finding them. Nobody's going to do it. So this is the whole idea. Now, again, in the real world, do we get it exactly balanced? Just like in a football spread? No. But on average, that's why it's called expected value. On average, it balances. So also remember that price is the point of disagreement. You kind of touched on this a minute ago. You think that selling the put, let's say for $1, is a screaming great deal. Well, then ask somebody, or ask why would somebody be willing to buy it? So if I can sell this put for $1, then the only reason that somebody should be willing to buy it is why? Because they also think it's a great deal relative to risk and reward. So in this case, the $1 is the price where we agree to trade. But the reason it's a point of disagreement is that the buyer thinks it's too low and the seller thinks it's too high. It's exactly like a point spread in a football game. Hey, Stu, there's a 10-point spread. I'm still going to take the home team. What am I really saying? I think the 10-point spread is too low. They've mispriced the tail. If you take the other team, even though your home team might be your team, you might bet against them from a betting standpoint because you think the point spread is too high. You're betting on the tail. That's what everything boils down to. So this is why you should expect, before you start texting everybody, hey, everybody, look, I found you can sell this put with an 80% win rate. Hit the brakes. Yellow light. Does it sound too good to be true? Ask why. This is why. This is the good mental image that you want to have.
So look, it's not that you have to. It's not that you should go out all the time searching for that 80%.
Some
I have an
people do.
80% probability win. Like you can feel free to take the other side. I do it. Everybody.
Oh
In
yeah,
fact, we have services that do that. Right?
sure.
Ryan does the short iron
Hmm.
condors. You're selling out of the money put spreads and out of the money call spreads.
That's right.
And you're not getting a lot of money for them. It might be a $10. I think we do them for about $2 total on a $10 wing. So you're betting 8 to win 2. Like oh, why would I do that? That stinks. The
High
balancing
probability.
point comes on where are you on that distribution. See, that was the point of the whole thing. That was what John was talking about when he was
That's
when he was mentioning it.
right.
It's where are you falling on that distribution curve? What kind of probability are you trying to get yourself involved with? And once you figure that out and you understand that there's a super low probability that that event will actually happen, and you're willing to accept, we'll just call it minimal or lower dollars for it than you would on something else, there's nothing wrong with that. There's nothing wrong with that. That's what trading is.
It's
That
exactly what it is.
that's what options. That's how options are priced. That's what the world does when we price options. It's how we make up the matrix,
Right.
and it's cool to do that. It's fine to do that. There's nothing wrong with doing it. Just understand that it's not free money. That there's obligations, and that betting 9 to win 1, or betting 2 to win 8, or betting 8 to win 2 comes with probability advantages or disadvantages.
Right.
That's the whole game, right?
So let's say that this over here, that somebody thinks that this is worth 90 cents. Okay, what's the market? How's the market going to price this? At 360. See, it always has to be in this 4-to-1 ratio. Now, what if they do this? What if we have this at where traders are claiming an edge? So if they have an edge, let's say if I win $1 80% of the time, but only lose 2. Now, again, that would go contra to what the theory says, but for some reason, that's what they think. What's going to happen here, Stu? The weight over here is not big enough. What happens to our seesaw?
Yeah, it's gonna right.
It's
They
going to
have to
flip here.
balance out
And
somewhere.
now this becomes a what? Either a screaming good buy or
Bye.
this becomes a screaming good sell.
Relative to
Relative
one
to,
another.
it's not going to sit there for long. It can't.
No, no.
That's a
In
whole
fact, in
point.
fact, these days it won't even sit there at all.
It's not
Those
even going to.
orders will come flying in. Be
They will before you. That's exactly right. Yeah. So when we talk about this, it is assuming that we get very big discrete moments of time where we can analyze this. What I just demonstrated here would be fractions of a second. It's just you're not going to see it.
Nanoseconds, yeah.
Okay, so let's get into some of the pricing. Now, before we do, you heard me talk about Q&A. Shoot that QR code right there. Stu and I do this every Tuesday, Thursday at noon Eastern. We have beginner, intermediate on Tuesday. Beginner on Tuesday, intermediate, advanced on Thursday. And
Yeah.
today we're going to do a breakout session on
Futures.
futures. Yeah,
Yeah,
talk
really
about
cool.
that.
I'm looking forward to that one.
So it is a phenomenal deal. We've had a lot
Yeah.
of people ask about it. And if you want to really get down to understanding options,
Yep.
that's your
You
code right
you
there.
throw us a question and we answer it.
We're going to answer. So now let's talk a little bit about more about this idea of tails. The first thing you have to understand for trading, or one of the first things, is that dollars are outputs. So if we look at our pricing model, we have stock price, exercise price, risk-free interest rate, time to expiration, and volatility. Stock price tells us the center of the bell curve. This tells us which slice we're playing. And the time and the volatility tell us the width. And if we know that, think about, even though you don't see it, it's drawing mathematically a bell curve. And from that, we can say, well, if you want to play this slice, it's going to cost $3.
And by the way, these are all interchangeable,
These
everyone.
are all interchangeable.
Right?
But
You
what
can put the
traders,
price in and leave out the time to expiration, and the models will give it to you.
right? But what traders do is they say, well, I think the stock is going higher.
Hmm.
Oh, look, I can buy this for 3. I'm controlling stock for 3. What a great trader am I? No, you don't realize this is an output of the distribution. Options only see this piece right here. Which exercise price are you pricing, or which, if you're doing, let's say, a spread, which slice of the bell curve are you pricing? And people get that completely backwards. So here's a good visual that we did in Miami not too long ago. We can actually do what's called a lattice. It's actually a visual way to look at what's called a binomial pricing model. But let's look at a coin flip. I can flip it and get heads or tails on flip number 1. Flip number 2, I could get heads followed by heads, but I could also get heads followed by tails. I could get tails followed by heads. So those are the 4 outcomes. I'm sorry, I could get tails followed by tails. Those are the 4 things we could get. But there's one way to get 2 heads, walk along this path. There's 2 ways to get here, right? I could go, there's 1, there's 2, and there's only one way to get here. So a lot of times you'll hear us talk about the path. This is a very good discrete way. Think of just walking through the woods here. These are different paths to get to this destination.
So people like, should the two-way path be priced the same way as a one-way path?
Exactly. Right.
It's an obvious
Exactly.
answer,
It
right? I
cannot
mean,
be.
it can't be.
No, it can't be.
Otherwise, it'd be what we call an
Free
arbitrage,
money. So now
right?
let's do it with this is with 5. All right. So if we went through the same math, here's 5 heads, 4 heads, 3, 2, 1, and 0. Well, it turns out there's one way to get here. That's just to walk along here. There's 5 ways to get there. Kind of hard to see, but like there's 1. I could do there. I could do that. There's all different kinds of ways. 5 of them to be exact. There's 10 ways to get here, 10 ways to get here, 5 and 1. So if we do that, let's say we walk along this path, that would give us 3 heads. Okay, so this is again what we call a discrete, meaning that we have spaces in there. On a bell curve, it's super, super finely divided up, but this is really what's happening. And that's why it's a good teaching model. So let's look at this. Watch this, how interesting this is. Let's say on the first flip, we get heads. Now remember, there's 5 that we're going to do. 1, 2, 3, 4, 5. On the first head, what just happened? We talked about this in a recent Coach's Corner, showing how the flipping coins, you start pulling in from the tails. In just one step,
Think about everyone. Think about what you're not seeing, what you're not looking for. What's
or say what cannot happen now.
yeah,
We know
right.
for sure we cannot walk on that path.
That's right. See, that goes away.
All that goes away, but it gets even trickier. I also cannot go tails, heads, tail. I cannot get to those either. So this is why in a very short time, option prices can change quickly. So what happens now is that half the branches just got removed. We had 2 to the 5th before, now we've got 2 to the 4th. Think about that. In one small step, half the branches just went. So now, again, now we've got 4, 3, 2, 1, and 0, and it gets repriced. So if we went to count, there'd be 1 way, 4, 6, 4, and 1. Now, let's do this. Let's do a coin game. We're going to flip it 10 times now. You're going to win $1 for each head. What should you pay for this? It's exactly like an option. We're saying, what should you pay for certain paths? So now here's our lattice with all of the number of ways. There's 252 ways to get exactly 5 heads, 120 ways to get 7. Then obviously there has to be 120 to get 3, right? Because if I get 7 heads, that means I got 3 tails. Or if I got 3 heads, I must have gotten 7
Yeah,
tails.
the other side of the trade.
Other side of the trade. So the fair value is $5. So what that means is that if we were to do this over and over and over, not counting commissions, we would just go sideways. That's what it means. Again, could you win? Sure.
Yep.
Could you lose?
Yep.
Yes. But in the long run, going nowhere. Now, let's say, what's the $5 call worth?
Yeah, but it was fun, Bill.
It was fun. So let's do this. Let's say that we have a $5 call. We can exercise this. It's only going to have value if we get 6 through 10 heads. In other words, what are we choosing? This becomes interesting. What are we doing as a trader if I say I want the 5 call? I'm saying I don't want those branches to be included. And it turns out, mathematically, this is not just a metaphor. I went through and did the calculations. It's worth 61 cents. And here's kind of illusion number 2. People say, well, look, that stock could be worth 6 or 7 or 8 or 9 or 10. Yeah, but what is the option worth? You have the right to pay 5. With it worth 10, you're only saying I want a $5 payoff. If it lands with 8 heads, you're only getting a $3 payoff, right? You've got the right to pay 5, 7. So your payoffs are much, much smaller. And there's only a 38% chance of getting these payoffs, and it's worth 61 cents.
That's
There's
one side of the
nothing magical about it. It's just a low probability bet, period. But yet people say, oh, look, I found this trade where I can win 80% of the time. Who cares? Yeah, you're just choosing a different slice. So as Stu and I like to tell people, you want to think of yourself as a trader, as a branch manager, right? That's what you're doing. Which branches do I want to play? Which ones do I not want to play? Now let's take it a step further. What's the 6 call worth? What are you saying now as a trader? You're saying, I don't want any of this. I only want to play here. Now, if we have the 6 call, the right to exercise for 6, the payoffs are 4, 3, 2, 1. Not very big, right? People misinterpret that. They'll say, oh, it's $1,000 stock. I've got the 980 call, or I'm sorry, I've got the I've got the 1200 call.
Yeah,
well, if it gets to 1201, it's worth $1.
At
But in their head, they're going, oh, it went from 1,000 to 1,200. I'm going to be worth a fortune. No, you're playing for $1. So here's your payoffs. Turns out there's a 17% chance, and the math says that is worth 24 cents. If you pay 24 cents over and over and over, you'll just break even. Nothing magical. You're just choosing which part of the tree to play. What's an 8 call worth? Now you're really getting into the low probability stuff. You only have a payoff of either 1 or 2, 1% chance, it's worth 1.2 cents. But what do traders do? Wow, I can control this thing that might be worth 10 or 9, not realizing that's not the
look how
payoff.
cheap it is. See,
And
that's
then
a
going,
trap.
look at how cheap it is.
Bill's
but look at all-
explaining, this tree is explaining the trap. Look, you can go further out of the money.
Of course, anybody
Keep
can.
going.
Roscoe can do that.
You're
Sure.
getting a lower probability. Same thing,
That's all you're
the
doing.
probability distribution, nothing changes whether you're on the buy side or the sell side.
Exactly. Nothing changes.
It's all the same.
Yeah.
Right. So if there's a 1% probability on the buy side, there's a 1% probability on the sell side.
On the sell
You
side.
pick which one you want to do. Right. But it doesn't go away.
It does. It's the
And
same,
it does
same tree.
change according to how much you want to bet.
It's the same tree.
I mean, you're not moving the line, in Vegas on a football game.
Exactly.
I don't think most of us aren't, right? I mean, so that none of that changes. All that is pretty static.
Right.
And you have to look, if when Bill said, how much is the 8-1? If you didn't say lower, maybe you didn't really. I mean, I didn't even know what the real number was, but lower is the answer, right? And when you can get like the why part of this, now here's another trap. See, like look at the top, from the quarter up to the 1%. Well, that's a huge payoff, right? Pretty low probability. But look what happens when you start selling like this put and that put and that put
Mhm.
and that put and that put and that. Now all of a sudden it's like, wow, man, this really works. Look, you got lucky.
You
You
just
got
got
lucky with high probability that it won't happen. Okay, cool, man. I love it. Keep
good.
the money coming in.
It's not income. It's
It's
not
only
free
it's
money.
only a
You got
matter of
lucky.
time till something bangs you. It's
Right.
gonna.
We
It
we
just
talked about this with we usually call it trading the felt in Vegas as a an example with roulette. It's the same board, not counting the 5 number bet, but everything else has that 5.25% edge against you. So take your pick. Do you want to play red black? 5.25 edge against you. You want to play a column bet? 5.25 edge. Street bet, all the same. That's the same thing here. The tree doesn't go away. The felt doesn't go away. So if you place a chip on a single number and you get 35 to 1, you shouldn't go pat yourself on the back and go, hey, everybody, look, I got 35x. Wow, that's amazing. How did you do that? It's a publicly available payoff. It's right there on the distribution. You played a segment of the curve and you won, period. Doesn't mean you can repeat it. See, and that's where people get into trouble because they see this relative to this and they think it's skill. Once you understand that you're pricing a tree or a bell curve, it's going to greatly change the way that you see options and strategies.
now.
So options don't care about the path. They only care about the outcomes. Options price the entire tree. And the question to ask is how much are you paying for the outcome? Now, a couple of quick things here about probabilities. Another little diagram here. If we look at strikes, remember options only knows strikes right there, and we have the stock at 100. So here's our at the money, probability of profit. I'm sorry, probability of being in the money looks like 50%. If we go in the money deep enough, we can have virtually 100%. But once we start getting close to at the money, what happens? Probability of being in the money starts dropping off radically. So if
And
you
let's
buy
make
the
the
one,
distinction here. This is not profit.
no, it's just the
I mean,
probability of being
a
in the
penny
money.
in the money is in the money.
Correct. So
You
if you
might
buy
take
the
a penny on
120
the option.
call, I mean, your probabilities that you're just playing a small part of that tree. And yet people do this. They buy these way out of the money calls and they go, oh, it's a good deal because I've got time. I'm using a leaps option. Don't worry about it. We've got time. That is absolutely 100% false. You're playing a very small
You
segment
bought
of
the
the tree.
time.
You bought the time and
You
you're
paid
playing a
for it,
very small segment of that tree
and you paid for it up front.
and you paid for it. Now
And
let's
if,
look
and
at,
if you have an up tilt out in time, and it's you may
might be
even
even worse.
pay more. So just one thing here, but referencing John again when he was talking about this distribution, he was talking about huge big players, Warren Buffett, Michael
Right,
Dell, Bill Gates, that they kind of really didn't care
right,
what happened, right? Warren Buffett has a team,
right.
and they say we're okay with buying the market at 6,500,
Mhm.
and they're going to sell that put,
Yeah.
right? And they're
Because
going to take
they probably would have bought it down there anyway.
and they would have bought it anyway. Like they don't really care
Right,
that the world at that point when it's going
right,
down and hit
right.
6,300, right? They're good with that.
Yeah, and Warren Buffett
They're
even said, if somebody wants to pay me whatever it was, $2 billion today that I can invest, I'm willing to take the other side.
I'm willing to take the other side, right, Malcolm? The same. So that's big picture stuff. That's a commitment on a price. That is like it doesn't matter what happens. I guess in the big picture in a long run, but that's a bet that they make that
Right,
they're willing to commit to. That's
right.
different than, oh, earnings are coming out and blah 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 stock. Let me make a bet on it and collect $1 because it's 6% out of the money. Look how much vols are pumped.
And we
Right.
hear that all
That
every
is
single day.
not what was going on in John's reference when he was talking about the
It's
put sellers of the world.
right. It's also easy, which we've talked about, when it's other people's money. It's very different when you only have your account and you just happen to hit the one big hurricane and you were completely wiped out or negative equity, which I've seen happen many times. It's
Same.
different when you're running multi-billion portfolios that's not your money anyway, and you're taking a small portion of it. Yes, it still magnifies into big dollars, but it's still managed risk, and people miss that. So now let's look at the probability of profit. This is just the probability of being in the money, and this is where people get this mixed up as well. Kind of surprising. Look at that. About 50% for very deep in the money. And then when we get at the money, going off a cliff very, very quickly. Why is that? Stu, why would we have, if we're super deep in the money with a probability of almost 100% of remaining in the money, why would the probability of profit be 50%? Well, if you have the stock at 100 and you have, let's say, the $70 call trading for 30, on a break even standpoint, it's at the money.
That's it.
You're everything. So this is another big area that people miss. The probability of profit. You're buying this 120 call or this 140. I mean, you were talking about such small probabilities, and yet traders go, "Don't worry about it. I've got 2 years." Makes no difference. It's
Bill,
just a wider bell curve.
that's a whole other topic
A
here.
whole nother topic.
Well, I'm not buying a $30 option. Look how expensive that
Look how
is.
expensive it is. I'm going to buy this one for one
Are you
cent
kidding
or five
me?
cents.
If you could buy that $30 option with the scenario that we just put forth, 70 strike price, $100 stock, if you could buy that for $29.50,
Let's take it.
it's underwater.
It's underwater.
It's below parity.
Below
It
parity.
doesn't get any cheaper than that.
Does not get any
It is
cheaper.
free. That is free money,
And
actually.
yet, yeah, exactly. And yet people will turn that one away.
Turn it away because it's $30 because it's a $30 option, right? The option is in the extrinsic value. It's not in the intrinsic
Yep.
value. That the
That's just
delta could be or is in, part of it. You want that 80 delta, you got to buck up the intrinsic value.
right.
That's not really the option part of it, right? That's just the cash to make it
Make
even.
it fair. Yep.
Yeah.
So let's now that we've kind of covered in the last two Coaches Corner sessions these different ideas about tails and what every bet really is. Buy or sell, call or put, it is a tail bet. Now let's boil down to the key question that we hear all the time in the chats. So remember, now that you know what a bell curve is or your tree, if this is great for selling puts because I've got an 80% chance of picking up some gas money for the weekend, then why is it when people go over here, they go, this is great for buying calls because I'm controlling stock for so much less? This is out of the money. See, what they're doing is they're making the argument here about probability, and over here they're making the argument about price. And it's the same argument.
Right.
You should say if this is out of the money and a low chance, then you should say this is an out of the money option with a low chance. And to be on the buy side is not good, but traders make them both good.
Didn't I read somewhere like puts or calls and calls or puts? I think I read that
You
somewhere.
certainly did. We talked about
Right? I
that
mean, if you think that put sale is great, and that's okay,
okay, but it's
then
only
you
because of
have to also
probability
say then the buy side of that put sale is terrible.
is terrible, or
And
the buy
the
side of the
same has
call
to go for the other side.
got to go
Exactly.
for this, right? And
It
yet
must.
traders think they're always on the good side, and they'll say, "Well, this is great because it's a leaps contract, and I've got 2.5 years, and I got time on my side." Wrong. You're playing this part of the
And I
curve.
don't even have to
Period.
look at it
I didn't
because
have to
it's
look
so
at it.
much time.
You're playing this part of the curve. Period.
Drives
It's
me
an optical
crazy.
illusion. Right. So anyway, hopefully, Stu, that has driven home these points to people about that everything is a tail bet, and if you ignore these are the ones that are going to bite. So be wary of at the money strikes. We're not saying they're bad, just be
No,
aware of what you're doing, but be extra wary of out of the money strikes. And if you
just
say, well, but I'm selling it, fine. What's to be wary about? The size of the loss. If you want to pound the table about I'm buying out of the money calls and look at how cheap they are, fine. Then consider the probability of loss.
that's right. That's all we're trying to get everyone to do here. Just think about when John said that word distribution,
Yeah. We said,
I thought
nice.
to myself, perfect. That's what we try to teach.
We try to teach, and it's
How
never
does
taught out there.
distribution work? Probability, pricing, in the money, out of the money. How do the numbers slide up and down? What are you getting? What are you giving up? That's what we do.
Right.
That's what trading options is about. It's not about, well, I'm going to sell this and get lucky, or I'm going to buy this and it's a home run. That stuff's going to happen, and it can happen fairly often.
Yep. So let's revisit our chalk talk, and I think people have the answer here. Selling out of the money puts is easy money. Again, I know you think we're kidding about this. We hear it every day. You will hear it too. Watch all the chat rooms and YouTube channels and stuff. People talking about it's easy money. I picked up gas money. I'm paying off my car by selling these puts. Is it easy money? True or false? It is 100% false.
Right.
100% false. It is not easy. It's not free. And so, if you can at least keep that in your back pocket, it's going to go a long way into keeping you out of trouble. So, we hope you, again, as always, that you picked up a little tidbit here to make you a better trader. That's always our goal here on Coach's Corner. And thanks for joining, and we will see you next week.